Today, I'm going to talk about how I would turn $5,000 into six figures trading in the stock market. It could be 10,000, it could be 2,000, but essentially, I'm going to be giving you the exact blueprint that I would use today if I started over, okay, to grow my account to six figures and beyond. So I'm excited for this webinar. I've got about 30 minutes. I won't be able to go into the amount of detail that I would like to. However, I will do my best to, cut out all the fluff and teach you exactly what you need to know. Now, real quick, if you don't know me, my name is Mark. I've actually been trading for the past 8 years. I originally got my start trading in crypto. This was back in 2016, and in 2018, I transitioned into the stock market, and I've been trading full time ever since. This was just me documenting a $9,000 profit back in 2017. I've documented my success on this YouTube channel, showcasing hundreds of thousands of dollars in profits, providing more transparency than 99% of people in this industry. You can see here a screenshot from my broker. This is my live account balance on March 23rd when I made this slideshow. 478,000. I keep about $500,000 inside my broker, which is TD Ameritrade, or technically Charles Schwab now. The Thinkorswim platform is the regulated U.S. broker that I use. Okay. All right. Now, what have I done? Just so you know, I haven't been hiding under a rock or sitting in my parents' basement. And, I'm actually a real person in real life. So I was a guest speaker at the largest trading conference in the world. Okay. This was in Miami about a year ago. Actually, it's currently where I live here in Miami. This is a photo from the conference. You can see here, giant photo of me looking a little egotistical. I did not ask for that, by the way. I actually started what at one point was like the largest trading podcast. In 2023, we were ranked in the top 5% of all business podcasts and top 1% of trading podcasts. And that is me there shooting a podcast live with some special guests. I've been a guest on dozens of shows and podcasts myself. You can see here, Digital Social Hour, massive podcast. You can go check out the episode if you want. So just so you know, I'm a real person. And like I said, not hiding in my basement. Now, I pride myself in proving I'm profitable by giving everyone access to see all of my positions in the stock market. Okay, so my trade entries and exits, which also means that I have students essentially mirroring my success. They copy my trades themselves. You can see I just took a screenshot from my trade journal of these are my recent trades I've taken. So the net ROIs, I'm on a nice little win streak here, with the profits. And then this is a photo from my first office that I had. This was like 2 years ago, actually a little over 2 years ago now, and my crazy 6-monitor setup. Okay. All right. Trading really is how normal people are making life-changing money. Now, these are 3 students that I've actually worked with, that I worked with over the last year. Jaden, he's 24 from Oklahoma. He actually made $10,000 profit in one day. Ligmatus, he's 22. He was able to make $22,744 profit from his college dorm room. And lastly, or really I'm just showcasing 3 of my students. I've worked with hundreds of people. But William is a 23-year-old. He had no trading experience when I met him, and he was able to make 119% return on his account in under 1 month. I actually spoke with all of these 3 individuals, really nice guys. I recorded the whole call live. It's on the YouTube channel if you want to go listen to it. They just shared their experience working with me. Okay, so how have I and hundreds of others found success through trading in the stock market? Now, first off, realize that 99% of what you've seen on the internet is total BS. So I'd really like you to approach this call with an open mind and a clean slate. All right, for your sake, just forget about everything you've ever heard or learned about trading. this should be a fresh start for you, okay? Now, my main focus in today's training will be edge and risk management. Essentially, the only two topics that you actually need to know that actually matter if you want to find success trading. Now, what is edge? Okay, you've probably heard of having an edge, which means you have an advantage over someone else. Now, this is kind of my definition of an edge. Now, an edge is what is going to distinguish, or is what distinguishes your input, and in return output from someone else's. Okay, in this case of trading, having an edge means your input will result in a positive output. So compared to someone else's input resulting in a negative output. An edge is going to separate you from everyone else who is trying to make money trading. So let's talk about the three types of experiences that you will have as a trader. The first is a negative experience, all right, where you are going to put something in and you are going to get something negative out. I'm going to use these words input and output and the word feedback loop, even though this isn't a traditional feedback loop, but I like using this kind of analogy to explain the way that you or someone else will end up having a positive, negative, or neutral experience in the market. So I like saying with no edge and no risk management in the market, you will have a negative feedback loop. So you'll get less out than you put in. You will not be a profitable trader with a negative feedback loop, right? You have no edge, no risk management. You'll put money into the market. You'll get less money back than you put in. Should make sense. Now, with a neutral experience, your input is going to result in an equal output, okay? So with an edge in the market, but with no risk management, or vice versa, with risk management but no edge, your feedback loop will probably look like this. You put money into the market, and in return, you get the same amount of money back. Okay, this means you're trading flat. Overall, you're seeing no gain but no loss. Now, lastly, this is where we all want to be, right? We want to have a positive experience. Having an edge and risk management will result in a positive feedback loop. So in other words, you put something in, whether that is time, money, or both, and in return, you get something out. This applies to anything in life, but in trading, we want to put time and money into the market and extract more money out of the market than we put in. Okay, right? That is the core understanding of our goal as a trader. So just to recap, the three experiences you are going to encounter as a trader in the market are either going to be negative, neutral, or positive. We want to have a positive experience. But in order to have a positive experience, we need both an edge, right? And we need risk management. That means that we will be seeing a greater return in comparison to the input. So we put money into the market, we get more money than we put in. I hope that makes sense. Now, our job as traders is to answer these 4 questions. Pay attention really close. This is a very important slide. Now, question 1. You've probably asked yourself all of these questions if you've ever traded before. What stock do I trade? What direction is that stock going? Where or when am I right? And where or when am I wrong? Now, as far as you asking yourself, well, what stock do I trade? This is where, the strategy actually comes in. So whether you use watch lists or scanners, order flow, whatever the case may be, this would be your strategy to find the stock you want to trade. This is where you need to have an edge. Now, number 2, what direction is that stock that I just found, right? What direction is that stock going to go? Again, this is part of your strategy, whether you use indicators, Fibonacci retracements, moving averages, whatever the case may be. This is where you also need to have an edge. Now, 3 and 4 pertain to risk management. So where are you going to be right? Where are you going to set your take profit? And then where are you going to be wrong? Where are you going to set your stop loss? So these 4 questions without being able to answer these, without being able to have a solution to each one of, well, these are virtually problems that you will encounter as a trader, you will not have success. Now, I want to dive right into risk management. I know my face is kind of wandering all around here, so I apologize. These are a couple risk management terms that you need to know in order for everything that I'm going to talk about to make sense. Now, number one is win rate. So how many times you win versus how many times you lose. Let's say you take 10 trades, 6 of those are winners. 4 are losers. That means you have a 60% win rate. Super easy. The second term is going to be risk to reward. So how much are you risking if you're wrong compared to how much you will make in return if you're right? This can be in either dollars or percentages. Now, for example, a 1 to 3 or a 1 to 3 means you're risking one part, dollar, percentage, contract, whatever it may be, to make 3 in return. Okay, so you might see people display risk to reward as RRR, a 1 to 3 R, or say R multiple, but it all just means the same thing. It means risk to reward. So a 1 to 3 R means you are risking, for example, $100 to make $300 on a trade. If you don't understand these, just pause it, read them. You need to understand this. So now, kind of the basics when it comes to risk management. Obviously, our goal is to have a positive expected return, or ER. I like using this abbreviation, but we want to make money, right? Now, expected return is calculated using win rate and risk to reward. Now, this is what you will see in your trading, or typically looking at anyone, if you're looking at their data and how they go about trading. You will see a higher win rate and a lower risk to reward, or a higher risk to reward and lower win rate. I know the first time I heard that I was confused, but it'll make sense in a minute, don't worry. So our job as traders is to find a balance between win rate and risk to reward to make the most profit possible out of our system as a whole. As a little quote I wrote when I was making this slide. I hated math until I realized I could make a lot of money with it trading. I know risk management is not one of the most glorious topics, but it is vital, like I said, in your success. Now, how to manage risk according to the way you trade. People don't realize there are 2 separate ways you can actually go about managing risk. This is kind of a realization I had earlier on, which really just led to a whole lot more success, in my trading. Now, you can let risk dictate your trading, or you can let your trading dictate risk. Okay, you can let your risk dictate your trading, or you can let your trading dictate your risk. The whole purpose of either is to decide at which point you are right, okay, and at which point you are wrong, and based off either outcome, knowing exactly how much you will make or lose in either a percentage amount or a dollar amount. So then in return, you're able to get the risk to reward, okay? Because without a risk to reward, you cannot manage risk correctly. I'm going to give you some examples. Here is an example of trading dictating risk, okay? So deciding where you are right and wrong based off technical or fundamental analysis. Setting a stop loss, take profit levels on a chart based off of moving averages, support and resistance, using indicators, trend lines, news, whatever the case, that is going to give you, or you will be presented with, a risk to reward. You are using some technical or fundamental means, right, to figure out where you're right and where you're wrong. And in return, because you've decided where you're right and where you're wrong based off of, like I said, maybe a support and resistance level, well, then you're going to get that risk to reward. So your trading is going to dictate your risk. Now, here's an example of risk dictating trading. Now, defining your risk to reward based off of a percentage amount or a dollar amount that is predetermined, okay, and has not been dictated by a chart bias or technical means. So let's say if your position hits 30%, you are out with a profit. And if your position hits negative 15%, you are out with a loss, regardless of any chart bias. Does that make sense? So if you enter a position, let's say you buy one option contract, you haven't looked at a chart, you haven't done any technical analysis, you're not deciding you're wrong based off of a resistance level or a moving average, you're simply deciding you are wrong because you are going to be down 15% on, let's say, that contract. Or you are right because you're going to be up 30% on that contract. Very important to understand this. You can pause it and read it. And if you aren't already, just please be taking notes. It's like one of the best ways to learn. Now, let's go over some data that you need to manage risk. Now, this is specific to the trade, okay, you're looking to take. These are the 3 data points that when you actually go to put on a trade, these are going to be based off of, well, that trade itself. So you're going to want the asset value in dollars. I'll explain why dollars and percentage later on, but you're going to want the asset value in dollars. So whether you're trading shares of a stock, futures, contracts, any entity or any asset, option contracts, doesn't matter. You want your asset value, right? And then based off of that, you want your upside percentage or dollar amount. So how much are you going to make based off of that asset value? And then on the other hand, you want your downside in percentage or dollars. So how much will you lose based off that asset value? Okay, so say you have one option contract that costs $500, that's your asset value. Well, how much are you going to make on that, right? If you're right, if you hit your take profit, and how much are you going to lose on that if you're wrong, if you hit your stop loss? This is, these 3 data points are specific to your historical data, okay? Or we can use benchmark data, kind of just depending on how you dictate risk. So you're going to want your win percentage, your win rate, right? So how many out of, if you've taken 10 trades, how many have you won, right? We covered that earlier. So your win rate in percentages, you're going to want your average winner in percentages, and you're going to want your average loser in percentages. So on average, out of all the trades you've taken, what's your average winner? What's your average loser? Okay, this is the historical data or benchmark data you're going to need. Now, based off your data, here are the risk parameters. These are 2 very important key concepts of properly managing risk that you have to also understand to their full degree. And I'm trying to do my best job here to make this as straightforward as possible because I know this can be a bit overwhelming. So, break-even win rate. What is break-even win rate? I kind of wrote down how I would best go about describing what that means, and then we'll talk about how that's actually going to apply into our trading, into our risk management. So the break-even win rate is essentially the win rate you must achieve in order to break even or trade flat. Now, this is based off your historical data. Very important. Your break-even win rate is based off your historical data. Now, what is break-even risk to reward? Now, the risk-to-reward ratio, the break-even risk-to-reward is the risk-to-reward ratio you must achieve on a trade in order to break even or trade flat, okay? So we talked about risk-to-reward. You know what that means. So the break-even risk-to-reward is the risk-to-reward ratio you must achieve to trade flat or break even. Okay, this is also based off of your historical data. Now, these are 2 variables that can be referenced each time you go to decide whether you want to put on that trade or not, right? Whether that trade is worth taking or not. Let me give you a couple examples. Now, break-even win rate. You only want to take trades that present at or below your break-even win rate based off historical data. So let's say if a trade presents a 66% break-even win rate based off the risk to reward presented behind the trade, and your historical win rate is 51%, then you should not take the trade. Make sense? On the other hand, if a trade presents a 40% break-even win rate and our historical win rate is 51%, then that means the trade would present appropriate or optimal risk. All right. Now, next, let's talk about break-even risk to reward. So, you only want to take trades that present at or above, at or above your break-even risk to reward based off of your historical data. So for example, if a trade presents a risk to reward ratio of a 1 to 2, but our break-even win rate is a 1 to 3, then you should not take the trade. Okay, so if the trade you're looking to take presents a 1 to 2 risk to reward, let's say you're risking 100 to make 200, but our break-even risk to reward is a 1 to 3, you shouldn't take the trade. On the other hand, if a trade presents a, let's say, 1 to 1.5 risk to reward, and our historical risk to reward ratio is a 1 to 1.5, or say a 1 to 2, so at or above, then that means the trade would present appropriate or optimal risk. I know I'm throwing a lot at you guys. I know this is not easy to comprehend. I just want to show you my risk management calculator because I, like you, more than likely, I don't love doing math. This is a lot. I get it. It's overwhelming. I actually took it upon myself to create what I call a risk management calculator. You can see here a screenshot of what it actually looks like. Now, in this next slide, I want to explain what it does. Now, essentially, the risk management calculator is going to allow you to trade variable risk to reward. It's going to take into account your win rate, your average winner and loser in percentage. It is going to distribute more or less capital into trades based off historical probabilities in order to maximize your account profits. So essentially, like let's say you have a trade setup that yields higher or lower positive returns, the risk management calculator is going to size accordingly. It is also going to let you scale your account consistently based off your performance. It works with any account size, and it takes into account break-even win rate and break-even risk to reward. And it does all of this by adjusting your position size. Because guess what? The biggest variable in your profitability is position size. So the entire goal of the risk management calculator is to give you just that. It's to give you your position size when you're going to put on a trade. Okay, now, if you would like access to the risk management calculator, it does come as part of my mentorship group. I'll link it in the description below. I'll put the application link to my mentorship. You can apply there if you'd like to learn more, if you'd like to use the calculator yourself. If you are currently not making money, it'll get you to the point where you're profitable. And if you're already profitable, by design, it'll just help you squeeze the most profit out of your account as possible. But, hopefully, I've just given you enough information to find success without it. But just remember, if position size is not adjusted based off of the risk to reward, then you'll end up giving back your profits. And that's what happens with a lot of traders. So in essence, you're kind of restricted to trading consistent risk and consistent position size, which will be a bit limiting as far as the trades you can or cannot take. Now, we've talked about risk management, okay? You obviously know in the beginning we talked about the experiences that you will have as a trader. We want to have a positive experience in the market. We want to make money. Now, in order to do that, it doesn't just require risk management, it also requires having an edge in the market. So, what is my edge in the market? Unfortunately, I've run out of time, but in the second part of this seminar, I'm going to be explaining what my edge is, how it came to be, and we're going to bring all of the pieces to the puzzle and put them all together so you will have a plan that you can actually take action on to grow your account from that $2,000, $3,000, $4,000, $5,000 mark into six figures and beyond. But that is the first half of the blueprint. That is exactly what you need to know pertaining to risk management. And like I said, in the second part, stay tuned. Make sure you're subscribed. Turn on your notifications. I'm going to be covering the second part. That was the first part. I'm going to cover the second part. So if you guys, again, are interested in learning all this, if you want this to be all fast-tracked, if you want the A through Z guide formula, the tools, everything that you need pertaining to those four questions, right? We covered those four questions that you will be presented with as a trader. I've been able to create answers to all of those questions. All of that is covered over inside my mentorship group. So again, click the first link in the description below if you would like to apply. I hope you guys did enjoy part one of this seminar, and I will see you guys in part two.